The geopolitical competition has intensified in recent years, with shifts among the world's leading economic powers. The United Kingdom is developing strategies to strengthen its relationship with China amid trade and security challenges. Simultaneously, the United States is increasing technology control measures, targeting China's semiconductor industry to curb its technological ambitions. China has confirmed its withdrawal from U.S. public debt, signaling resistance in the economic rivalry. These developments reshape the global order and create challenges for countries balancing economic interests with long-term strategies. The global economic battle continues as the world enters a new era. The West is reevaluating its strategic direction, while a new U.S. president prepares for a trade conflict with China. The European Union maintains a firm stance against cooperation with Beijing. But countries like the United Kingdom, Italy, and Spain recognize the necessity of engaging with China for economic stability. This marks a significant change, especially considering past tensions between Western leaders and China's president. The UK's attitude towards Beijing has transformed from a hard-lined stance to pursuing closer ties. The British Prime Minister is expected to visit Beijing, and the Finance Minister is working to foster deeper economic relations. This shift comes amid the impact of global trade policies, including tariffs and pressure on Europe to increase U.S. oil and gas purchases, causing economic strain. The EU is concerned the UK could be the next target. The UK Labour Party leader recognizes the negative consequences of tariffs and emphasizes maintaining sustainable trade relations with the EU, its largest trading partner. Over 42% of UK exports go to the EU, and over 50% of UK imports come from the bloc, demonstrating mutual dependence. However, the EU faces challenges, particularly importing costly energy from the US, increasing production costs, and creating difficulties for its economies. The UK faces dual pressure, importing expensive energy while maintaining export competitiveness to a weakened EU market. These challenges are exacerbated by Brexit, with the UK economy suffering estimated export revenue losses since leaving the EU. Under these circumstances, it's essential for the UK to reassess its trade policies and build new cooperative relationships. Nonetheless, in an increasingly volatile world, balancing economic interests with political strategy remains a significant challenge for the UK and the rest of Europe. In 2022, over 16,000 small businesses in the UK faced a significant blow, ceasing their exports to the EU. The data revealed a troubling trend, with exports from small businesses falling by as much as 40%. While larger companies performed better, the overall trend of the UK's exports continues to decline. In this context, the trade war initiated by the Trump administration risks putting the UK in a position where it can no longer rely solely on Europe as it once did. The Trump administration also demanded that NATO member countries increase their defense spending to 5% of GDP, imposing significant pressure. If most of these funds are allocated to purchasing weapons and equipment, it would offer little benefit to either the EU or the UK economy. Meanwhile, the EU is grappling with its own financial difficulties, making stronger trade ties with the region increasingly unfeasible. As a result, much like other EU nations, the UK is now compelled to engage with China, an economy that is not only growing steadily, but also gradually distancing itself from the United States. Given this context, evaluating the UK's trade strategy becomes crucial. The United States remains the UK's largest trading partner, with trade volumes exceeding $100 billion. However, China is emerging as a key strategic player, ranking second among the UK's import partners, with a total value of $56 billion. China is also known for supplying low-cost goods, which are essential if the UK seeks to mitigate the impact of US tariffs. Although UK exports to mainland China totaled only $21 billion. When adding Hong Kong's $10 billion, China collectively becomes the UK's second-largest market for goods, with a total of $31 billion. It's noteworthy that the UK's reliance on the Chinese consumer market is increasing, especially as China works to develop its domestic market and decouple from the United States. This evolving relationship with China is critical for the UK, as it seeks to secure its economic future in an increasingly complex global landscape. This situation presents a significant opportunity for countries like the UK, which need to diversify their trade and reduce their dependence on the US. By 2025, should the US impose severe trade barriers on the UK, increasing trade with China could become a crucial survival strategy. This shift is not coincidental, but part of a growing trend that is likely to intensify in the coming years. The UK is quietly undergoing a transformation marked by a strategic shift in its approach to global economic and political engagement. There is a clearer emphasis than ever before on trading and investing in ways that align with national interests. Notably, discussions about China's support for Russia have been overshadowed by other pressing economic concerns, such as the decline of the UK's automotive industry. Amid this crisis in domestic car manufacturing, the UK seems to be seeking assistance from Chinese electric vehicle (EV) companies. The UK automotive sector is showing clear signs of struggle. The historic Vauxhall plant in Luton, owned by Stellantis, is at risk of closure, reflecting similar issues across Germany. Production costs in both the UK and Europe. Energy costs in the UK and Europe are rising to unsustainable levels, and technology, particularly in electric vehicles, lags behind China by several years. UK car production has fallen 30% compared to last year, the 9th consecutive month of decline. From a peak of 1.8 million vehicles in 2017, output has dropped below 990,000 in just 7 years. U.S. America First policies under both Trump and Biden administrations, encouraging reshoring of manufacturing, exacerbate these challenges. This has increased energy costs for the UK and Europe, while pressuring local industries. Chinese involvement in Europe's automotive sector may become a last resort. 2025 is projected to be a turbulent year for the UK economy. Meanwhile, the global tech war focuses on the semiconductor industry. The Biden administration continues implementing measures to curb China's chip industry growth, intensifying the chip war. Beijing strives to dominate the global chip market, producing chips for various industries from cars and computers to weapons and appliances. The U.S. has responded with restrictions on advanced chips and manufacturing technologies, targeting companies like ASML and Tokyo Electron, to prevent these products from reaching China. However, targeting legacy semiconductors has made China more vigilant. China controls over 30% of the global legacy semiconductor market, projected to grow to 39% by 2027. Many products using these chips, from TVs and electric vehicles to laptops, are predominantly sourced from China. This dominance mirrors China's capture of the solar panel market through cost reductions and increased production. By 2030, China is projected to produce 50 million 12-inch wafers annually, surpassing the combined output of the US, EU, and Taiwan. China's growth has prompted Western trade sanctions, particularly from the US, to protect competitiveness. These measures include import restrictions and economic isolation of Chinese products, aiming to rebuild domestic manufacturing. However, their effectiveness is uncertain as China expands its global influence. Semiconductor companies hesitate to invest in the U.S. due to Chinese suppliers offering chips at 30% to 50% lower prices, attributed to China's supply chain advantages, including lower energy costs and control over domestic mineral inputs. Even shipping minerals from China to the U.S. is cheaper. The U.S. may impose tariffs on older chips from China, potentially ranging from 50% to 200%, to protect domestic manufacturing. This risks dividing the global market, creating two systems. One trading with China and another aligned with U.S. protectionist policies. By 2030, electronics are expected to account for half the cost of a car, with electric vehicles using at least 3,000 semiconductors, including mass-produced chips. American consumers could face higher car prices due to domestically produced chips being more expensive than those from Asia. This could trigger a global tariff war. As global trade shifts, two distinct U.S. markets are emerging, one engaged with China and another pursuing isolationism. The decline in U.S.-China trade has significant implications, notably China's reduced reliance on the U.S. dollar and its decreased dollar-denominated foreign exchange reserves. China's holdings of U.S. Treasury bonds are at a record low, and this trend is expected to continue, posing challenges for the U.S. economy. Reshoring production to the U.S. remains expensive, especially with the Federal Reserve's recent interest rate cuts and limited projected cuts by 2025. The U.S. government faces rising borrowing costs and potential decline in global demand for U.S. bonds, even as G7 nations remain net buyers. The U.S. Treasury yield curve is unstable, with rising yields impacting interest rates in the U.S. bond market. China's issuance of its own dollar-denominated bonds further intensifies competition, as demand for these bonds rivals that of U.S. bonds. This challenges U.S. financing, particularly as China can borrow U.S. dollars at lower interest rates than the U.S. government. Chinese investors are increasingly buying Chinese government-issued dollar bonds, driving yields below those of U.S. Treasury bonds. This strategy aims to reduce capital flow to the U.S. and increase global capital market competition. These changes are projected to intensify by 2025 as Western sanctions ease and China disrupts the U.S. dollar system, transforming the global trade and financial landscape. Leading up to the U.S. presidential election, analysts have debated the winner's impact on U.S.-China relations. However, there's a widespread belief in China that tensions will persist regardless of the outcome. This perspective, shared from policymakers to citizens, holds that every U.S. administration, whether Democratic or Republican, seeks to curb China's global rise, particularly economically. Under the Trump administration, tariffs were imposed on Chinese goods, and a campaign against Huawei was launched. The Biden administration adjusted the tone, seeking to stabilize communication, but maintained consistent policies toward China, focusing on technology through investment and export controls, as well as tariffs. Chinese analysts predict that significant improvement in U.S.-China relations is unlikely regardless of the election outcome. Experts agree that U.S. policy toward China is likely to remain unchanged. Yin Heng, a professor of international relations at Renmin University in Beijing, stated that the continuity of U.S. policy will overshadow any potential for major changes. J.Y. Kenrong, associate dean at the same university, echoed this sentiment, saying that China will remain the U.S.'s main rival, with only tactical differences between administrations in the U.S., both Democratic and Republican. Experts believe that a tough stance on China in trade matters will continue. Eswar Prasad, an economics professor at Cornell University, suggested that a victory by Donald Trump could exacerbate trade and economic hostilities, accelerating decoupling between the two nations. However, even Vice President Kamala Harris could implement tougher tariffs, a step Biden has already taken. Carlos Casanova, a senior economist at Swiss private bank UBP, noted that trade tensions between China, the U.S. and Europe will likely persist, with a bipartisan consensus emerging in the U.S. for tougher measures against China. Recent surveys show that over 55% of Americans are unaware of the impact of trade with Asia, including China, on job creation. Only 30% believe that trade with China has created jobs in their state, and only 25% consider trade with Asia beneficial. Most Americans see trade as a zero-sum game, believing that other countries benefit more, particularly in the case of China. Experts predict that during the next presidential term, U.S. economic policies toward China will remain firm, focusing on tariffs and efforts to restrict China's high-tech sectors, such as semiconductors and artificial intelligence. The main differences will lie in the methods employed, with Democratic administrations favoring targeted measures while Republicans may adopt more aggressive approaches. Chinese experts, such as Jin Kanrong, acknowledge that U.S.-China relations have entered a phase of comprehensive competition, with confrontation becoming inevitable. As a result, China must continue to strengthen its domestic manufacturing sector, particularly in high-tech fields, while promoting the Belt and Road Initiative to secure a proactive strategic position in its rivalry with the U.S. During Trump's presidency, China took steps to prevent trade tensions from escalating. But according to foreign policy experts, Beijing is expected to respond more assertively in the coming U.S. presidential term. One potential response could involve imposing heavy sanctions on select U.S. Fortune 500 companies, particularly in sectors where China can provide alternatives. Additionally, China might expand restrictions on critical mineral exports and implement other export controls. Beijing could also sell off a significant portion of its U.S. Treasury bonds, which it currently holds. However, the most impactful move might be allowing its currency to depreciate further, which would directly undermine U.S. tariffs and complicate Washington's efforts to weaken the dollar and reduce trade deficits.